following segment sponsored by Mears Associates. On this week's edition of Financial Corner, we want to welcome Mark Mears of Mears Associates to Daytime for a discussion on insuring your parents and grandparents with annuities. How are you doing?
I'm doing great. How are you doing today?
Doing good. Walk us through this. Why should we have annuities for our parents and our grandparents?
You know, there's a lot of negative information about annuities floating around. A lot of times when I talk to people about annuities, they'll say, I don't like annuities, and mainly it is because not understanding them. But here's the big benefit. If a person has, and these are examples, you know, anytime you want specific tax information, you need to talk to your own CPA, but these are just general ideas that will require more explaining later on. But if a person has $100,000 in the bank, like a lot of people do in a CD or an IRA, let's say an account that's earning 5%, in theory, $100,000 at the end of the 5-year period, the balance is somewhere around $105,000. If the owner of that account dies, the beneficiaries will get $105,000. But there's a lot of annuities with death benefits. So if you take that same $100,000 and put it in your grandparents' name, or if they've already got the money in their name, it could easily have a death benefit of $45,000. So when that person dies, instead of getting $105,000, they're going to get $145,000, and there are absolutely no medical questions. That is one way to get big leverage on some of your cash that may be dribbling around 4 or 5% interest.
And I know a lot of folks want to do those savings, do those 401ks. They do all the things that they do to save money to pass something along to their future generations.
Absolutely. And
this even goes further to help future generations as well.
No doubt. Most of the people I talk to that are over 65 that have 100, 200, 500,000 in the bank or an IRA, they have no plans whatsoever of spending that money. They want it to go to their grandchildren. Well, again, now this is a bigger number. On $1 million IRA, if you put that in certain types of annuities, it can create an instant $450,000 death benefit. I mean, do the math. And that death benefit increases each year to keep up with inflation. So, yes, legacy planning. Making sure that your grandchildren have money to buy their first car, college, marriage, first baby, and all this can be taken out in segments from that annuity instead of taking it all out at once and maybe not managing it the best.
When folks come to you and talk to you about annuities, you mentioned that up front, they're sometimes a little leery about annuities. What are some of the questions that folks need to ask when they come to you or someone like you to talk about annuities?
The two biggest things is the liquidity. How liquid is the annuity? The other one is there's two different types of annuities. There's annuities that invest the money in the stock market. There's annuities that pay fixed interest rates. The annuities we deal with do not invest in the stock market. I'm not saying that type of annuity is bad. It's mainly designed for a younger generation, which I'm talking about between age 30 and 50. But when you get over age 50, you want to, maybe 55, you want to be a little more secure with your money.
And so you'll have that legacy in place.
Absolutely.
All right, Mark Mears, we appreciate you.
It's always great to
Great
be
information. Mears Associates, located right there on Fort Henry Drive in Kingsport. We have a number for them right there, or go to markmears.com for more information. The preceding segment sponsored by Mears Associates.